Good morning. I want to call the hearing to order. Select Committee on Youth in California's Future, along with the Standing Committee of Banking and Finance. I want to thank everybody for being here today. I'm Assemblymember Ian Calderon, and I chair the Select Committee on Youth in California's Future. First, I want to thank my counterpart today, Assemblymember Matt DeBobney, chair of the Assembly Banking and Finance Committee, for joining me in this hearing and being a part of the discussion on an important topic. The U.S. Financial Literacy and Education Commission defines financial literacy as the ability to make informed judgments and to take effective actions regarding the current and future use and management of money. Financial literacy not only includes the basic skills of balancing a checkbook or computing interest rates, but the ability to use that information to make informed decisions about one's future, financial future and stability. This continues to be a growing issue and is already affecting Californians in many different ways. For example, the lack of financial literacy depresses college graduation rates and home ownership, which is at historic lows currently. Increasing mortgage default rates, increases the number of bankruptcy filings, and increases dependency on welfare services. Further, up to a third of the wealth gap can be explained by the large difference in financial knowledge between the wealthy and the poor. Studies have shown that addressing financial literacy early in K through 12 education leads to positive outcomes later in life, such as better credit scores and lower debt delinquency rates. Updating K through 12 education is one way to address this issue, but there are many private and nonprofit organizations already working diligently to improve financial literacy in our state. The legislature must address the lack of financial education in our schools. So today I want to explore how we continue to improve financial literacy in our state and ensure that the next generation receives the necessary tools for success. At this time, I'd like to turn it over to my vice chair for the day, or co-chair, I should say, for the day. Vice chair sounds better, but Assemblymember DeBobney.
Mr. Calderon, thank you. Like usual, I'm to your right. That was funny. No, I really do want to take an opportunity to thank Ian Calderon for this. He's been a great advocate for financial literacy since his time of election. He's been a great champion for obviously making sure that millennials and those that are not even voting age yet and coming into voting age now have a voice in the assembly. He's barely older than them, but that's okay. So I'm happy we're having this hearing today because we need to raise awareness in regards to the epidemic in states facing surrounding financial literacy. Too many Californians are financially illiterate or unbanked, and really those two things go hand in hand. Data released from the Federal Deposit Insurance Corporation show that 68 million adults in America are disconnected from financial systems in some way. That's right, 68 million Americans. That's more people than that voted for the Republican candidate in the last two presidential elections. Currently, 17 million are unbanked, meaning that they do not have any form of a bank account at all. Another 51 million are underbanked, meaning that they have bank accounts but rely on alternative financial providers such as check cashiers, pawn shops, or payday lenders to meet some or most of their banking needs. Together, unbanked and underbanked adults account for more than 34 million households, a number that's remained fairly steady since 2011. In California, if we had a clear strategy of financial education, we can improve these numbers dramatically. Unfortunately, for over the last 2 or 3 decades, we have done very little to address these concerns. As chair of the Assembly Banking and Finance Committee, I've made it my goal to tackle this issue and create a path where more young adults are provided the basic financial tools when they graduate from high school. High school graduates enter the workforce or go to college lacking basic financial survival skills. They do not know how to balance a checkbook, let alone understand the difference between a stock, a bond, or a certificate of deposit. They will later become part of the masses of 25 to 34-year-olds who have the average credit card debt of over $5,000, with 1 in 10 owing more than $7,000, and will spend nearly a quarter of their income just on debt payments. Research suggests that teaching financial education early helps to create a healthy financial management habits for later in life. Thus, integrating lessons into school curriculum is much more effective than trying to cram it down students' throats as they're about to graduate. Students engaged in financial education year after year will help them master these concepts so it becomes part of their daily decision-making process. With the dizzying proliferation of credit and debt cards, non-traditional loans, instant credit, and internet-based financial transactions, more people make financial choices independently and at much younger ages than previously. Most of our schools, however, have not adjusted to this new financial order. Schools teach our children about math and science, but are not about credit scores, annual percentage rates in today's world. Knowing that we have a number of students throughout our education system that will graduate knowing complicated mathematical formulas and understand calculus, but don't even understand what a FICO score is or have a basic understanding of how credit card debt works is somewhat troubling. If children leave school without understanding basic financial concepts, it might be too late. I also have learned in my own community when we do these financial literacy events for young people, there's a great benefit. They often go home to their parents and they start talking to their parents about some of these concepts. Many of their parents have never been exposed to these, understanding the basic financial services either. So when we have an opportunity to educate children, much like cereal companies market their ads to children because they know they'll have repercussions and have an influence over what their parents buy at the stores, being able to educate young people on financial literacy will obviously have a dramatic effect on the whole household at large. During this legislative session, I'm carrying Assembly Bill 1784, which will allow banks to partner with schools to create school-based savings programs on school campuses. These programs teach students about the importance of savings and financial management. In addition, these programs provide a valuable service to the community. California should serve as a national model for financial literacy. Instead, we fall short. We may pride ourselves on being a progressive state with our stands on global warming, privacy, healthcare reform. We are, though, losing ground to states like West Virginia, Kentucky, South Carolina, who have all mandated financial literacy curriculum for their students. This is unfortunate and somewhat embarrassing. It's my hope that today's hearing will highlight the need for financial literacy among our young people and show the need for centralized state policy that will exhibit our commitment in giving our children all of the skills they need for success in the modern economy. It's not just enough to get a good job if you can't manage the money you make from that job. Like the chairman said earlier, this has real-life implications on owning a home, buying a car, and even getting a job. More and more employers are actually asking for credit scores and to check someone's credit to make sure that they're worthy for employment. We need to make sure that we're educating our children not just on the curriculum that will help them get a job, but on curriculum that will include financial literacy to help them manage their money once they're employed. Once again, thank you to Chairman Calderon for this important meeting and my colleagues who took the time to be here today.
Thank you, Mr. Chair. And to your point, when it comes to my district, I've hosted a couple different financial literacy events in lower moderate income areas of my district. And when I do that, I will mail to several thousand individuals in my district, but yet be lucky if I get 10 people to show up. And so once you leave school and habits are set, it's hard to get people to feel the need to go back or understand the importance of taking time to learn a little bit more. At this time, I'd like to open it up to committee members that would like to give any opening remarks. Ms. Gonzalez.
Sure, thank you. And as a member of the Select Committee on Youth and California's Future, I was really excited to see this today. And to your point, Mr. Dubovne, I have a 20-year-old daughter who could pass the AP Calculus test, had a Coogan account most of her life, had worked, and yet when she opened up a checking and savings account and I looked at where she was putting her money, she 2-to-1 had money in her checking account. I asked her why, and she said, because they gave me a check, so I had to put it in the checking account, right? It floored me. I mean, we're talking basic what you can do with a check, because unlike when we were kids and went to the bank with your parents, most things are done online, and kids don't necessarily even have, when they're in the best situation, don't have necessarily what seems to be common sense to them is not to us. So they need that understanding, no matter which level or economic level that they're at, to understand what they need to know. And of course, they're going away to college, signing student loan obligations and having to immediately determine whether they want to start paying interest on those loans. I mean, there's so many simple and complex financial decisions that young people are being asked to make these days that this is an important and timely meeting. I'm going to be in and out today, so I apologize for that, but I really appreciate both these chairs for bringing this timely topic up.
Thank you, Ms. Gonzalez. Any other members like to say anything? Mr. Cooper?
Good morning, and good to see you all, and I want to thank the chairs for convening this. This is really critical, and I've got 2 adult children, and as they were growing up, we taught them about finances, and one just bought a house, my oldest, and we helped her out with that. So a lot of things we were able to teach my children over the years with regards to financial literacy, And even now she's a state worker, and first thing I told her is invest in deferred compensation. So a lot of parents don't have the ability to do that. And by holding some of these financial literacy workshops, which I've had in my district, have been used for folks because they don't have the ability to learn these type of skills from their parents for whatever reason. And I think we as a society need to make sure we help these kids to make sure they're successful in life. And obviously finances have a great deal to do with it. And this is just a great program really to bring more attention to what's going on with our kids, because a lot of folks are struggling out there. And I think this points them in the right direction, because once you get behind financially, it's hard to keep your head above water. So thank you very much to both chairs.
Great. Thank you, committee members, Ms. Gonzalez and Mr. Cooper. So we're going to go ahead and start with our first panel entitled Understanding the Problem. And we have Tina Lozano, Chair of the California Jumpstart Coalition, as well as James Chen, National Director of Youth Empowerment for Operation Hope. And if you guys come up front and go ahead and get started when you'd like.
Good morning, Mr. Chairman and Mr. Chairman, and committee members. Thank you for the opportunity to speak with you today about the urgent need to provide personal finance education to California's youth. I'm Tina Lozano. I'm Executive Director of the Richard Miles Johnson Foundation, which is the state credit union foundation for California and Nevada. And I'm here today in my role as Chair of the California Jumpstart Coalition. California Jumpstart is comprised of individuals and organizations that have a strong commitment to bringing personal finance education to the youth in California. Our partners offer programs and resources in schools and after-school programs and in the communities of California. My task today is to provide you with information regarding the lack of financial literacy among our state's youth. Here are a few statistics from a variety of sources, including Sallie Mae, Nellie Mae, the New York Federal Reserve Bank, and demos.org. And you do have a copy of my testimony, so you have these statistics for your reference. 1/3 of high school seniors have credit cards, and over half have them by the age of 19. Only 17% of students pay their credit cards off each month, and they carry an average balance of $1,600. Up to 25% of all student loan borrowers in the last 9 years have defaulted. 3 out of 4 teens are unable to decipher a pay stub. Over half of teens and young adults overdrew their bank account last year. Only 1/3 of parents report teaching their kids how to balance a checkbook or how credit card interest works. A little bit of good news. Half of teens are eager to learn about money, and 89% of teens believe financial education should be taught in schools. Recognizing these issues, many states have taken steps to include personal finance education in their state standards, mandating that a course be offered, be taken, and often be tested for graduation. Only 5 states remain that have no personal finance included in their standards, and California is one of those 5, according to the 2016 survey of the states by the Council on Economic Education. FINRA's Investor Education Foundation funded a study that was released a year ago, February, that, quote, examines the effectiveness of state mandates on financial education for high school students, documenting notable improvements in credit outcomes for young adults who were exposed to rigorous programs, end quote. They looked at credit scores and delinquencies for young adults in years prior to and after the implementation of mandated financial education programs in high school. Georgia, Idaho, and Texas were chosen for this study, and each had a similar control state with no mandate. All 3 states have significant programs, meaning that standards are imposed. They offer significant courses, which is at least a semester. They have testing requirements, and they're required for graduation. These programs also provide teacher training. Young adults who participated in these courses and turned 18 after the mandates had measurably better scores versus students in the control states. The study notes that if rigorous financial education program is carefully implemented, it can improve the credit scores and lower the probability of delinquency for young adults. 3 years after implementing a financial education program, all 3 states examined saw significantly increased credit scores, and young adults in all 3 states had lower delinquency rates on credit accounts. This study shows undeniably that there is a benefit to financial education. Here in California, we recently passed AB 166. It states that the next time revision of textbooks or curriculum frameworks in social sciences, health, and mathematics, the state board should ensure that these areas integrate a number of different components, including financial literacy, including but not limited to budgeting and managing credit, student loans, consumer debt, and identity theft security. In line with this legislation, one important effort we at California Jumpstart have been working on is to call for more substantive inclusion of financial literacy education in the history and social science frameworks revisions, including an optional 9th grade course. A small team of experts has compiled recommended edits to the framework to include specific areas of personal finance throughout the grade levels. We're hopeful that these edits will be taken seriously by the Instructional Quality Commission, chaired by Bill Honig. But this really isn't enough. Local control of education dollars means that each school district makes its own decision about how much, if any, financial education is taught in our schools. We need to find a way to ensure that every student graduates high school with the ability to manage their own finances, whether they're headed into college, vocational school, or directly into the workforce. Certainly, supporting programs such as business education that provides a real-world context to students is a start. The state can maintain and extend the CTE incentive grant of $400 million per year. The CTE standards are the only ones that I'm aware of that explicitly list financial education in the standards for all classes. But not all students take CTE classes, so we're still only reaching a fraction of our students. California Jumpstart is made up of many different organizations that are willing and able to help teachers teach these important lessons to our children. The teachers don't have to go it alone. They can bring in groups from Junior Achievement and Operation Hope to credit unions, banks, and local CPAs. All of them have curriculum ready to go. They just need to be invited into the classroom. The piece that's missing is the requirement that this information be taught. I'll close with one more statistic. According to a recent study by the Federal Reserve in Boston, only about 35% of those aged 25 to 50 with credit cards are quote-unquote convenience users who pay off their balances each month. That means that the majority, 65%, whom researchers call revolvers, carry debt forward from month to month and usually pay high interest rates in the process. Debt almost seems like an addiction in our country, and we need to ensure that we're giving our children the tools necessary to end this cycle. Thank you.
Great, Tina. I appreciate it. Just briefly, when you say that in your presentation that because of local control funding formula where the local districts control the money, that it could pose a problem potentially in terms of teaching financial literacy in school. So it's your assessment that by us giving control of money to local districts that it would actually hinder the ability for a school district to teach financial ed?
Well, I think that because each school district makes the decision about what they include in the classroom, that it's a matter of having to go to each school district to sell the idea of bringing personal finance education into the classroom. It's not the way it's currently set up. It's not like the State Department of Ed can say all students have to have this education.
No, I think we can. Yeah, we can pass laws in that.
Yeah.
I don't want to I mean, we passed a law last year. I think that Assemblymember Nazarian put in that would say that every student has to have a basic amount of coursework on their meaning genocide. I think we could do that.
It would be terrific.
I think right now there's obviously a multiple kind of prong approach with financial literacy in schools. I think if you find a really dynamic, teacher in different fields, I've seen some amazing coursework that they've included that in where they've got kids following the stock market and investing, and they're talking about personal finances. And then you have some school districts, unfortunately, where that isn't present, and the students leave without a basic understanding of, like we talked about earlier, not even knowing what a checking account really means, let alone what their FICO score means. But we'll definitely have to explore that later. But I do think we do have the ability to set into the curriculum standards, obviously through a legislative means. So.
Yeah. If there are no, Mr. Hadley.
Thank you, Mr. Chair. One quick question. I was a little intrigued that your recommendation was to take advantage of the history social science framework revision, essentially opportunity, if you will, where so much of the basics of financial literacy are really math. And so talk a little bit about a social science teacher doing this versus a math teacher doing this in ninth grade.
Certainly. Math is the obvious place to think of personal finance, and the math revision was done about a year or so ago, and we were able to get some personal finance into the math revision as well. But again, I don't think that's enough. In history and social science, you have econ taught in the 12th grade, and so that's a seemingly logical place to include some personal finance education. Beyond that, even health. There's a movement around looking at health not just as physical health, but also financial health and other types of health. So I think there are a number of different places in the curriculum where personal finance makes sense and is and would help to incorporate this education for kids as they go through their education, so it's not just a one-time shot.
Ms. Gonzalez?
I'm just curious because kind of tied to this, and something else we don't teach is basic labor laws. So a lot of kids are exploited. Of course, they don't know that, in their first job that they need to be paid for training. No, but it does tie into finances. So I'm wondering, has there been any programs that tie the two together? Because obviously we want kids to know what to do with their first paycheck, but if their first paycheck doesn't adequately reflect what they deserve, it's great if they can look at the stock market. It's even better if they know that if they're being ripped off by their own employer, in my opinion. So it affects many more students. I was wondering if there's any kind of programs out there, if you've seen any programs that kind of incorporate that type of financial literacy, which I think is an extension of financial literacy or workplace wage rights, basically.
Mm-hmm. I can't think of any specifically offhand. I don't know. I do know that there are, in San Francisco, there's a program, Credit Union has a program, and they work with the youth that have summer jobs with the city, and they do work with them on understanding their paycheck and what should be included in that. So I think there is some of that.
I think that's honestly makes a lot of sense too. When you look at the fact that you said most people don't understand what their paycheck actually means and the details and the different types of things that are deducted, how can you really know if you're being paid fairly or if you're being taken advantage of when you don't even look at your pay stub? And now with most people, they get direct deposit. They then have like these pay stubs that come to their office, but if your pay stub's not even connected to a check, how likely are you even to look at it? So when you look at that, I applaud the Assemblywoman for bringing that up because that's a good point. And you might not even know you're being taken advantage of because you don't know what the deductions are, what they're for, what they're adding up to. So,
right. Thank you, members. If there are other questions, we're going to move on to our next panelist, Mr. James Chen, National Director of Youth Empowerment for Operation Hope.
Good morning, everyone. Before I start, I want to just let you know, Mr. Calderon, that I came from Montebello this morning, a nearby district for you.
Welcome, and thanks for making the long journey.
It was an interesting one, definitely. But my name is James Chen. I'm the National Director of Youth Empowerment for Operation Hope. Operation Hope is a nonprofit organization based out of Atlanta. We're nationwide. Our mission is to empower youth and young adults who reside in low and moderate income communities. Our project goal is called 5117. The 5 represents 5 million youth educated in Banking Our Future financial literacy program. The 1 represents 1 million who go through our entrepreneurship program. The second one represents 1,000 Hope Insights, which is our brick and mortar face-to-face counseling for adults in small business, financial literacy, and credit improvement. The 7 represents our work to help clients achieve a credit score of at least 700. Now, I'm here today to provide a brief snapshot on the problem we at Operation Hope see daily from working with our constituents. I ask that you think back to when you were a teenager yourself and reflect upon who taught you the language of money and key knowledge areas such as budgeting, basic bank products and services, and, of course, credit. I'm confident that we all agree financial education and knowledge is critical, and it's absolutely a life skill. To this day, all of us in this room make financial decisions based upon what we've learned, what we've been taught, and mistakes that we've made in the past. These decisions not only affect us as individuals, but society as a whole. And that leads me to my first point, the cost to the taxpayer. Individuals under the age of 25 make up the fastest growing age group filing for bankruptcy. Easy credit, bigger student loans, financial illiteracy are fueling this trend. Only 47% of American teens report working with their parents to develop a budget for spending and saving their money. When a young person does not understand how to manage their finances and they are out of school, unemployed, or underemployed, they are classified as opportunity youth. In other words, these youth have the opportunity to succeed, but have not been given the tools to do so. The economic consequences of opportunity youth are enormous. To the taxpayer, each opportunity youth imposes a burden which is equivalent to $235,000 in a current lump sum. The full lifetime fiscal burden amounts to $1.6 trillion across the cohort of approximately 6.7 million opportunity youth across the nation. These numbers show how much is being squandered by failing to adequately invest in future generations. On to the next point that leads to a lot of confusion and perpetuates misinformation, even for adults, is loans and credit. Everyone in this room knows the benefits of having a credit score that is over 700. You've addressed it already. Whether we agree or not, these three-digit numbers can determine where you live, where you work, and the method of transportation to get from point A to point B. There's also stark contrast in the annual percentage rate between someone with a top-tier credit score versus someone who's on the polar opposite of the spectrum. How can we expect our young adults to have a good credit score if they don't know the reasons that lead up to what their credit score is? Operation Hope goes into classrooms daily across the country, where students take a pre-assessment survey to measure their baseline financial knowledge. Results show that the concept of how interest affects carrying a balance in their credit card is foreign to them. In fact, worse yet, many fall victim to the fallacy that credit card is free money until their monthly bill comes in the mail. Additionally, students perceive that carrying a balance and paying the monthly minimum payment is acceptable and even convenient, without realizing that a simple $200 balance can take upwards of 12 to 15 months to pay off in full. Another area that affects young adults today is, of course, student loans. The tipping point for student loans occurred in 2011, where student loans accounted for a greater slice of the debt pie than credit cards for the first time in the United States. In 2009, it was the housing bubble. Many economists today predict and fear that student loans are next. The reality is many college students still do not understand how loans work. Grace periods, subsidized versus unsubsidized loans, loan deferment, income-based repayments are all jargon that is confusing and identify areas that students have difficulty grasping. It is for these reasons why Operation Hope launched our Banking Our Future College Edition. We built on the success of our nationwide campaign in elementary, middle, and high school, and create a new curriculum geared towards the needs of our college-age students. My last point revolves around criticisms of financial education. We all know the important need of financial education. Recently, there have been critics of financial education who cite that the impact of a personal finance course taken in high school dissipate with age. They say that at 30, you do not remember the personal finance course you took at 17. They also concluded that those who have taken personal finance courses have similar asset accumulation levels and credit profiles as their peers who did not take these courses. This proves something we know to be true in behavioral economics. We're not denying it. Knowing better does not guarantee doing better. We are all clear on the damage that smoking has on your health, yet new smokers buy cigarettes every day. Conversely, we know that for anything, one class or one session is not enough to reinforce positive behavior and choices. It has been proven that people who do not know enough about their personal finance unknowingly make choices, accidentally even, that are harmful to their financial future. In conclusion, our goal as a collective should be to equip our youth and young adults with the tools necessary to make informed financial decisions. They don't need to know everything at that point as a teenager, but when the time comes up, they should know how to react. By providing an underlying foundation of basic financial topics, understanding their sense of awareness and heightening it, and enough understanding and confidence to ask the right questions is where we should be going. Thank you.
Thank you for your testimony. I appreciate it. One of the things that which is why financial literacy. I mean, there's many reasons why financial literacy is important to me, but one of the things that stands out in my mind is I just think about, my parents and then my generation looking at our parents about to, retire and the kind of situation that they're in. I mean, it was unfortunate that a lot of our parents kind of went through the piece of the recession where they lost their home, they lost everything. My family, right before the recession hit, my mother and my stepfather, they invested all of their retirement, all of their savings, equity in the house into a new business, which was about to kick off, and then ended up, the economy ended up tanking, and so all the funding from the investors that were coming through just stopped coming through right away, and so essentially their retirement security went out the drain. Because of just a downturning economy. And then, so I look at, just in terms of my position, my own family, I mean, I look at my brothers and my sister, and I think, well, okay, this is going to be our responsibility, because if something were to happen to them, there really isn't that retirement security that's there to help them out. It's going to be on me and my siblings. And so I think, a lot of kids and a lot of individuals growing up today, even in their 20s, they don't see the value of investing in retirement right here, right now. It's, if you want to be financially secure by the time you retire, you need to be thinking about that when you're in your 20s, starting something when you're in your 20s. But the fact that nobody's sitting there unless it's a parent telling them that, hey, this is what you need to do. I mean, you should be being told that. And, I think in school, where you're kind of trusting people to give you the information you need to help you not only compete in this global economy, but be successful for yourself in terms of how you handle your own money. I mean, it's, I know when you're in school and you get a job, you have access to money. The idea is I have money, I can go do things. I can go to the movies. I can buy this, buy that. For me, buy surfboards. So it's like, there has to be thought put into how, you responsibly use your money. What is your income? What is your, how much do you make and how much should go into savings? And I mean, I was great at saving when I really wanted. When I wanted a surfboard, lunch money, everything else, it was all went into savings. That became my income. I'd just rather not eat at school if it meant a surfboard. But I'm going to open it up, see if there's any other questions that committee members would like to ask. Mr. Chair.